Welcome to Better System Trader, the show for systematic and algorithmic trading. Glad you could join us today. This is going to be a really special one. I'm very excited to be having Fabio on the show today because we're going to be talking about a topic that I don't really, to be honest, know a lot about. I've got some fundamental understanding of what we're going to be talking about. So I'm really excited to be digging deep into this topic today with Fabio Ruggeri from MentorQ. Welcome, Fabio. It's great to have you on the show.
Hi, Andrew. Thank you for having me. Looking forward to the chat today.
Yeah, actually, we've been probably we spoke a couple months ago, I think, about coming on the show. So it's good that we've finally managed to get some time together to to meet. So how about we start off first with a little bit of context, just to give this a bit of background. So can you tell us a little bit of background on yourself and how you got started in trading?
Yeah, absolutely. So I'm from Italy, and I moved to London after university back in 2005, and I started working at Bloomberg in 2007, right before the first credit crunch. So it was a very interesting time to join a financial company in that time. And then I worked in London until 2014, and then moved to New York, right? And I had the opportunity to kind of like see how the finance world was changing from really traditional finance. So as you guys know, Bloomberg is the leader in the traditional kind of like data space, right? Where you can get all the information about markets and data. But then like I moved into an alternative data company, right? So I started selling alternative data. And the word alternative data means that some of these large institutions are buying data that is not typically commonly used by retailers or accessible. It's expensive data, but they use it to base trading decisions and create additional alpha or additional returns. So I was selling data to the largest hedge funds in the world, and I was seeing like how successful they were in embracing this data driven approach, and that got me really interested into what we are doing today, which is why we develop MentorQ. So essentially, yeah, the world is changing. You know, everybody knows about AI, and data is going to become very, very important, even for retailers. So that's what we're trying to bring there, give you access to data that you might not have access before, and give you like alternative data there as well.
Yeah. I've had a couple of people on the show in the past that have been from an institutional background. I think it's always interesting to hear, how the big boys in the markets approach the markets, and I guess kind of the competitive edges they have on us lowly retail traders. So I like that you've got that kind of insight into that world, and you're bringing some of this alternative data and these approaches into the retail world. Can you explain a little bit about? Well, I guess there is a kind of a trend these days that people are looking into more alternative data now. It's not just about the price chart, is it? It's like, can you get information from here and here? And I think it's kind of becoming more of a trend now. But can you explain a little bit more about what types of data you're talking about here, and why is it important to kind of start considering this type of data in our trading decisions?
Yeah, so I mean, as retailers, we are familiar with the traditional strategies, right? Fundamental analysis and technical analysis, right? Most likely technical analysis, because the data is easier to read. You can plot it into a chart, and it's very immediate for a retail trader that might not have the experience of an institutional person. But the world is kind of changing, right? So the world is interconnected, right? So like a tweet can affect the price of a stock, right? Or like something happening in the other side of the world that you might not consider could affect like the price of a company. Supply chain, we've seen what happened in 2021 with supply chain, right? Stock were dropping because their suppliers were not able to deliver the data. So like being able to connect these pieces of information together is becoming very important. And large hedge funds have been doing this for now over like 20, 30 years, and they've been very successful. We see some very good examples in the market where, in 2021, for example, the hedge funds really had an outstanding performance. And, this is because they embrace data-driven strategies. And when I say data, it could be anything. It could be, for example, weather information if you're trading commodities, or it could be credit card information if you're trading retail stocks, right? So being able to overlay that data sets to your traditional strategy could give you an edge and give you like that additional alpha that everybody's looking for, right? Because otherwise, everybody's looking at the same charts, then the decision that you make are not going to be effective because everybody's reacting on the same signals, right? So if you look at the example of technical analysis, a lot of people trade moving average crossovers, RSI, right? The whole market has access to that data, so the whole market could potentially trade that information. But being able to access information that is not publicly easily accessible, then that could give you an edge and can give you like a better leverage on your trading decisions.
Yeah. I love that because I had a guest on the show maybe about 2 months ago now, I think, and he made a good point that you've got all these millions and millions of computers that are running 24/7, trying to find all these patterns in the market, and it's all becoming a mess. And they're all looking at the same data, they're using the same indicators or the same algorithms to try and figure all this stuff out. So I think you're absolutely right that you need to be looking at different things and in different ways to be able to find something unique these days, because as retail traders we can't compete with these big hedge funds, and they've got all these really smart guys and unlimited budgets. So I like what you're saying here. So what specifically kind of data are we talking about here? Because you mentioned quite a few examples there. So where do you think that traders can find a good edge?
So I think a lot of this data will not be accessible by retail traders, and the reason is data is complicated, the data is very expensive, and it's not easy to manage it, right? So when you're looking at data, you need to have some know-how on how to handle databases and all of that stuff. But for example, we study from the options data, which I wouldn't say is easily accessible, but it can be accessible. Obviously, it has a cost, but it provides a lot of value. And I always make this analogy, right? When people trade using technical analysis only, it's like when you drive at night and you only have the lights of your headlights that are showing you the road in front of you, right? But having access to all this kind of information then gives you like a better overview of what's around you, right? So options data, especially over the past few years, and then we can show the audience some charts that like confirm this trend, but like especially since COVID, we've seen a big growth on options flow. So even if you don't trade options, you still need to pay attention, because sometimes the price movement of the stock that you trade or the futures that you trade is primarily driven by options. So we study with options. We're also looking at systematic funds data, but options for us is giving us a very good hedge that can tell you in which direction the market can go, or it can tell us is it going to be a volatile day or a non-volatile day. And then based on that information, then traders can use different strategies, from simply like directional trades to option sellings to iron condors, like small stuff. So there's a lot that then you can do with that information, but being able to decode that piece is very important, and that's what we are trying to do.
Yeah, I think many traders look at options as being kind of risky and complicated, and so they probably they try and avoid that type of trading. But you were showing me just before we started here that a really interesting chart actually on options volume. I don't know if you want to put that up on the screen, but it kind of makes a good point that traders like myself who have avoided them options in the past really need to start paying attention, right? Because well, why don't you talk about the chart here rather than me talking about it?
Yeah, absolutely. So I think we need to understand what has changed since COVID, right? So since COVID, we've seen a few trends. First, especially in the US, I don't know how it is in Australia, but we have now brokers that offers commission-free trading. So the growth of Robinhood or platform like eToro in Europe have really brought trading to a different level, right? So now everybody can actually create an account in a few minutes and start trading. And that has opened up like a new kind of audience to the trading space, because before it was kind of like, hey, if you trade, you need to have $10,000-$20,000, and you need to have the commissions were high, so you were like really not doing that. Then COVID hit and the lockdown, so people had more time to spend at home and like learning about trade. And then we had the whole GameStop saga happening in 2020, 2021, right? So now, like, people that didn't know what trading was, now they can start trading options and actually make money and make 100 to 100% return in a few days, right? So that kind of like open up a new generation where people that have less cash don't want to like invest like in an ETF at a 5% return, because you're not going to see an increase in your capital unless you wait like 10, 20 years. So options really attracted a lot of like investors that want to like, okay, I want a quick profit. I want to, increase my capital, and, I'm going to use options for that. The problem is that on the downside, as you mentioned, options are more complicated, and people that trade option and don't understand the variables that affect the option price, then they would just buy it and think that, the price is going to go up and I'm just going to make money. But in reality, options account for different variables like volatility, time to expirations, the price of the underlying. So a lot of the people that also bought GameStop options actually got burned because they didn't account the price of volatility. So it's true that they are complicated, but it's also true that if you look at this chart, they are going to provide you with a lot of value, because first, you don't need to trade options to be able to use that data, because the way the market works, and we can go into more details about it in a second. But essentially, if you are trading any asset and you're not looking at options, you're basically missing a part of the picture that is very important, which is where is the market going to go based on the option flow. So I would say like that you don't really need to trade options, but you should really know how the option market works, because it's going to give you a nice edge on your trading.
Yeah. Well, I'm interested to hear more about this, because you just said that there's kind of this option data has information which you can't see on charts, and it's like, well, there's these reaction zones or these hidden levels that you can't see by looking at a chart. So, do you have some examples? Can you show us a little bit of what you mean by that?
Yeah. So I think first of all, before we go into that, we need to understand kind of like a little bit of how the market dynamics work. So everybody has heard of what market makers are, but market makers become more important in the option market, right? Because think about when you trade a stock, most likely there's going to be a buyer and a seller on either side, and obviously there's a market maker in the middle that facilitates the transaction. Or there's an exchange, right? But when we look at options, think about how many companies are listed in the US and how many expiration we have and how many strike prices, right? So suddenly you're going to have thousands of option contracts for a single underlying, and it's going to be impossible to have always on the other side a buyer and a seller. So if somebody is not in the middle, then we have an illiquid market or an inefficient market. So that's why market makers are very important in the option market, especially because probably the majority of the transactions are executed by market makers. So you're always able, for a customer, you just log into your trading platform and you see a bid and ask price, and you don't know what's behind that, right? But it's important to understand that you're always able to buy and sell an option contract. That sometimes there could be a wider bid-ask spread, especially if you trade small caps or like a liquid option contract. But essentially, you're always able to buy or sell your option contract. So why is that important? Because on the other side, somebody else, if we don't have a customer on the other side, somebody else is taking a risk, right? And this is the market maker. So the market maker basically, first of all, how do they make money, right? They don't make money from the direction of the trade. They don't take positions. They don't make money from that. They make money from the transaction volume. So the bid-ask spread. So the spread between bid-ask is their profit, right? But to be able to do that, they are basically taking a risk. So if I buy a put option and the market start dropping, then suddenly the market makers are losing money, because I have the right to kind of like buy my stock at a higher price, right? So to protect themselves from losing money, they use a strategy called delta hedging, and we're not going to go into a lot of details today. But basically, in the simplest form, that means that the market makers is always hedging their positions, and that involves continuously buying or selling the underlying asset to maintain a delta neutral position, right? And that helps them to offset their risk, but at the same time, that adds liquidity or removes liquidity to the market. And that's why we start seeing those reaction zones that we can plot here in the chart. And that's what we're trying to analyze here. So this is kind of like coming from our models. We call this the net gamma exposure chart. And we try to understand, okay, where is the market positioning? So you see the wide green bar and the wide red bars. The green bars are the call positioning, or what we call call gamma, and the red bars is the put positioning, or the put gamma. So obviously our models it's a complicated model that looks at all the Greeks of options, but the essence of this is really trying to understand what are the price level where we can see a reaction coming from the fact that there's a lot of options at that strike price, and there is a lot of exposure at that strike price. So we look at the change in delta, the change in gamma, and then we forecast those reaction zones. So from the chart, you can see basically where's the market positioning. So in this case, we're looking at gold. This is a kind of like an old chart from a couple of months ago, but at this date, there was a lot of like positioning at the 2,400 level, right? Like a lot of like options were bought at that price. On the other hand, there's a lot of put positioning at that lower price there on the red bar. So when the market fluctuates and those prices are kind of approaching, then you're going to see a lot of reaction. And the reaction can come in different forms, whether it's like a reversal reaction or it's an inflection point where, similar to the GameStop example, where the price kept like skyrocketing high and we see those gamma squeezes because people are not selling their options and they keep buying, and therefore the market makers has to kind of like buy and sell the underlying stock to offset the risk.
Yeah. So as you were talking, or as you were showing this on the screen, I remembered a moment back very early in my trading career. This is early 2000s, and I was in like a online trading group kind of thing, and the head trader was always talking about options and saying the banks are going to protect this area and they're going to try and push the market up to here and things like that. And sometimes those levels were like, well, I know she was looking at the options data, but just looking at the chart, it's like that's in the middle of nowhere. How can that be? But I know we can't really see a lot on this chart here because it's only a small part of the historical chart there. But do you find that these options levels align with I guess traditional support and resistance zones and things like that to give more credibility, I guess, to just chart reading?
It could be, yes, but I would look at this chart. So I would look at the options data as a sentiment indicator from the market, right? So options data provides an immense amount of information on where participants are moving. So first of all, we can understand from this chart which are the strike price with the highest open interest and gamma. So knowing those strike prices can tell us, okay, there's a lot of investors that are buying out of the money calls, in this case at the $2,400 level, right? So that means that somebody, whether it's institutional or retail, have done the research and they are thinking that the price is going to go to that level, right? Maybe it's not going to go to that level, and we can't predict the future, but we can get this. From this information, we can define that there's a lot of bullish sentiment in the market compared to bearish sentiment. So that's like a good indicator, especially if you're looking at support and resistance level. But this becomes very valuable when you are looking to take profit, because the goal for trading is not to make money, but it's to not lose money, right? That's the most important part. I think that every trader should look at the trade as a plan. I have an idea. I'm going to risk X to make Y, but the most important part is always not lose on your trade. And knowing when to get out or when to stop is equally as important as like, hey, I'm making 10X on a trade. So that's why these reaction zones become very important. And then we can show you some example on the chart. But
that'd be great. Yeah.
But let me go maybe into details about what these levels are, because and I'm going to skip this part. So essentially, we divide those reaction zones into primary levels and secondary levels. And we look at the amount of gamma, and gamma is one of the options Greeks that obviously is important because it affects the market makers' delta hedging activity. So, the change in gamma can really affect the way the market moves. So we look at gamma and we look at delta, but essentially we come up with these levels. And the main ones are the ones that you see on the left. We're going to show you the core resistance, put support, the 1-day minimum, 1-day max, and then we have secondary levels, which are the ones that we saw in the previous chart, which are the bars that you see in the chart. But essentially, like the first one that is very important is what we call core resistance. And you don't have to look at this as resistance in terms of technical analysis, but you need to look at this as resistance in terms of options positioning. So in this case, we're looking at the Nasdaq future option chain and option positioning. And again, it's quite an old chart. It's a couple of months old. But at this point, we had a strong positioning on this area. But at the same time, we see a lot of put positioning on the bottom side, right? So, if you are in a long trade on the NQ, that could become your target because you know that if the price approaches this level, there's going to be a big barrier for it to go further because of the way the option market works.
Right.
On the same side, we do the same, what we call the put support, right? So if the market starts going down below that 800 level or 800 level, sorry, then suddenly that there could be a reaction at that level. So if you're short on that trade, then you know that there could be either a bounce back or there could be an inflection point, similar to what happens when you break support and you break resistance.
Right. Okay. Yeah. So, so then are these levels really only good for day trading, or what if you're a bit of more of a long-term trader? Maybe you're like a trend follower or a swing trader who trades over a few days. Are these levels still? Sorry.
Yeah. No, I think So this chart shows you the overall market positioning, right? So if the market is more positioned on the call or the put side. By knowing that, that can give you like a good idea of like, first you want to see the change on this chart on a day-to-day basis. So for example, if this level starts to shift, so if the core resistance moves up, then that means that there's a lot of like bullish sentiment that's coming to the market, right? If the put support moves down, then you know that, hey, there's more option activity to the downside. So even if you're like a swing trader, you know that something is changing in the market. So you might want to pay attention to that. But we also are developing swing trading models that can help you get like a better idea where the market could be in 5 or 20 days. And I can show you that as well if you want.
Yeah, that'd be great. I was just thinking, we've, I know a lot of algorithmic traders watch this show, and they're probably thinking in their heads, have you done any testing, or is there any evidence that these there's specific behaviors around these levels? Have you done any algorithmic or statistical studies on these levels?
Yeah, so I can show you some backtesting, and then I can show you our swing model. So one of the other indicators that we have is what we call the 1-day expected move indicator. So this indicator, it's obviously better tailored for day traders because it forecasts the next day price volatility range. So we have a maximum level and we have a minimum level. So as a trader, when you start your day, you know if it's going to be a volatile day or if it's going to be a more quiet day. And by knowing that, you can then imply different strategies. One could be directional, one could be selling spreads. So we have a lot of traders in our community that do like 0 DTEs, iron condors. So they would sell spreads, call spreads above these levels. And then they would sell put spreads below this level. And the goal is that the price stays in the range. And then at the end of the day, the option expires worthless, right? And they pocket the premium. Obviously, there is risk associated to that. But at the same time, you can get like good returns if the price doesn't move above a certain range. On the other hand, you can use this. So for example, if we see the price moving towards one of these ranges, then you could use it as a reversal trade or as like an inflection point again. but I want to show you some sort of back testing that we did, and this is all available within our website. So we look at and obviously option history is expensive and it's challenging. So we are building a back testing tool for all the assets that we cover. We have about 1,000 assets, but right now we have this level of history for SPX. So I want to show you here. So essentially, what does the back testing tell you? So for us, success 1 day minimum means how many times the price closes above the minimum level the next day. So on 87% of the cases from 2019 to 2023, the closing price of the SPX stays above the minimum level on 87% of the time. And on 85% of the time, it stays below the maximum level. So if we go back to this chart, then how can you use that? So a lot of our traders would wait for the price to approach one of these levels, and then they would trade in the opposite direction. Same with the minimum level. So they know that there is a confidence there that they can get better kind of like statistical advantage by doing that. We've also done some back testing on major stocks. Here you see the number of days. There's obviously less history. And again, we are working on that. And we're working actually with a large quant firm that is going to like actually back test all our data. So we are excited about that. But essentially, the results are in line to what you've seen before, right? So if you look at stocks like NVIDIA or Tesla, 86% of the cases, the price stays above the minimum level, and similar results above the maximum level. So if you're a day trader or if you're an option seller, you can use this level to basically place your bets more effectively.
Right. Okay. So the examples that you're showing us here, so the markets, are they essentially you've just got stocks and futures and commodities, or because you said 1,000 assets, I think I heard you say. What assets do you have available or data for?
Yeah, so we cover stocks, indices, ETFs, and futures. So futures, we are actually the only company that we are aware of that has actually futures option chain on futures. So if you're trading gold, if you're trading copper, if you're trading, even Forex futures, we cover. So yeah, we have Aussie dollars, we have, euro, but then we have also the stocks. So the reason why it's 1,000, because we're taking the stocks with the highest option activity, right? So obviously there's like 12,000 stocks in the US, but not a lot of them have like relevant option activities. So therefore the models won't work as well for those smaller companies, but for the biggest one with the largest option activity, which is basically the majority of what option traders use, then you get a really good levels and good reaction zones. So
yeah. I know as well that options data can be challenging to source and then clean and structure in a way that can be tested. How much data do you have? How far back do you go?
Yeah, so right now we are basically working on implementing over 10 years of data. So as I mentioned, we are building basically an historical database, and that's going to help us with our backtesting tool. Yeah, the challenge is obviously that it's expensive. So there is a cost that obviously sometimes can be prohibitive. And the challenge is also because options is not straightforward. So besides the typical market data of prices and expirations, you also have the Greeks. So we are actually, we have built our own Greeks calculation model that can help us then have a better analysis around the option, because we came across providers that don't have really good Greeks data. So then that becomes a problem, because when you start doing back testing, then you get results and then you go and analyze the data, and there's challenges in the data. So the biggest challenge is really having clean data. So that's what we are doing right now. So we are basically running our own Greeks calculations. We are running our own Greeks model because we want to make sure that the data is clean and accurate.
Yeah. So then how do you present that data to people who might want to start adding this into their you're trading, what platforms or what kind of data feeds can people get access to?
Yeah, so I don't know if I can share. So we right now, maybe I can share my screen.
Do you want me to put the screen back? There we go.
So let me actually bring up the screen. So we run our membership on Discord, and you can see here where we are in the process of developing front-end applications, so a web application where people will be able to log in, similar to a research platform, and we're starting to build that as well. But right now, our data is available via Discord, so we have futures data here, where you can get all these charts on index futures, commodities, metals, rates, forex, soft commodity. But we also have a bot. So here we have stocks. So if you're looking at the Nvidia or Tesla, we have a channel dedicated to that. But we also have a bot that we develop where you can come here and you can start typing a request similar to what you would do in ChatGPT, and the system would return you with the data. So this would be the charts that we showed you. We have a lot of other charts and other models, and then we have integrated our data into trading platforms. We now have TradingView, NinjaTrader, and MetaTrader. So people that want to look at the data not in a statical format, they want to actually look at it as the market moves real time, then we have really integrated the data into the trading platform. So within the bot, you can come here and you can request the levels. So this would be all the levels for SPX, NDX, QQQ, and Q. You can copy this text, and then we can go on our trading platform, and then we can see, I already have it loaded here, but we have indicators built for TradingView that allows you to plot these levels onto the chart, and then give you those reactions on. So if we look at, for example, Nvidia, these are the levels from yesterday.
Okay, so we just had some technical issues there, but Fabio's back. So we can see here you were just showing us how to put these levels on a TradingView chart, which we can see there. So I'm just trying to think.
So what we've done, Andrew, is really simplifying the concept of option data. So what we do is we leverage the same approach that large institutions would use, which is really use a data-driven approach. So we take options data and a lot of different other data sets, we simplify it, and then we create actionable insights that people can use. And what's more simple than lines on a chart, right? So here, so we really try to make it as easy as possible for everybody to understand. So essentially everybody's accustomed to support and resistance area. Again, yes, those are levels that are coming from the options data. So they give you an additional layer of protection here. And as you can see, for example, yesterday there was a very big level with a lot of different levels in the same area. And that's what happens to the price. The price try to break, fails to break, and then falls back down to the next kind of level. So so that's kind of how you would basically look at that.
Yeah, cool. So I think actually you just reminded me that I think you were going to show us something about swing trading as well, which we didn't get to. So do you want me to put the slide screen back up and you can jump back to that one? I think you were going to show me and I cut you off with some questions. So here we go.
Absolutely. So next week we are launching our swing trading model, which is very exciting because there you go. 1 second. Right. So yeah, thank you, Andrew. So next week we are excited to launch our swing trading model that will allow you to have levels that are longer term, so like 5 and 20 days. And why is that important? Because as you mentioned, not everybody is really day trading, right? There's a lot of risk involved in day trading. But if you know where the market could be in 5 days, or 1 week, or a month, then you could really, place your bets. The other challenge with day trading is that not everybody has the option to stay in front of a screen all day long. So some traders might not really look at that data because they're not day trading. So that's why we've come up with a model that is really tailored for medium longer term traders. So from a week to 20 days or a month horizon, and that can give you a really good overview of where the market could go. So within the levels, we provide with 3 data points. One is an upper band and a lower band. So every day, the model will have either an upper band or a lower band. And we calculate that based on a machine learning algorithm that we developed that is looking at momentum, options data, gamma, and delta. And we're trying to forecast the lower price that will be touched within the next 5 days, or the upper price that will be touched within the next 5 days, based on if the model has either a lower or an upper band. Then we have another level, which is what we call the risk trigger. The risk trigger is a volatility level. So it could be a respected within the next 5 days, but it could also be an inflection point that could then bring a higher volatility. So, an increase in the trend. So the success of the model that you see at the top right, which is really the backtesting results on this model, is looking at the green and red bar. So like for every day, you're looking at one of these bars and you're looking at the success rate of, is the price closing above the upper band, above the lower band, or does the price close below the upper band in 5 days in the future? And let me know if you have any questions on that.
No, I think this is fascinating to see, and as you mentioned at the start, traders need to start considering other types of data, and it's not just about looking at the chart these days. And I think what you're doing here to kind of make this accessible to retail traders is fantastic. So anyone who wanted to get access to this, where should they go? How can they do that?
Yeah, so you can go on our website, so mentorq.com, and basically you can try out our membership for 7 days. We're also running live sessions for the next 2 weeks. So from July 16th, we're going to actually present our product launch. So we have a lot of live session going on. So live trading with our traders. We're going to present our models. We're going to present a lot of different things. So yeah, stay tuned for that, because we're launching next week, July 16th.
Yep. Okay. And I'll put a link as well below the recording here for people who need to come back later and get access to this. So thanks a lot, Fabio, for sharing this. I found it fascinating, even though I'm not an option user yet. You're convincing me. So I think it's really fascinating what you're doing here and helping out the retail trading community as well. So before you go, do you have any final thoughts, any closing comments?
No, I mean, first of all, Andrew, thank you for having me. We've been chatting for a couple of months, and I think what you're doing great. Your YouTube channel, I really like it, and I think you're bringing a lot of value. Just to give you as a final thought, I think every retail trader should try always to stay ahead of market trends, because a strategy that would have worked in the past might not necessarily work in the future. So I think, as a piece of information, always read what's going on in the market. Always try to understand, okay, what are the trends? We're seeing a lot of things happening with AI. So being able to capture that will give you obviously a lot of hedge on your trading activity. So I think, that's very important.
Yeah, well said, and what an excellent way to finish the show today. So thanks again, Fabio, for joining us. And anyone who's watching this, please remember to hit like and subscribe so that you're notified anytime that we release any new content. So thanks again, Fabio, and I wish you all the best. Cheers.
Thank you. Thank you, guys.
Thank you. Bye-bye.